Hi there, future financial savvies. Do you have mountains of credit cards debts you cannot seem to get out of? Here are 6 different ways you can do now to get out of debt, and you are on your way to saving instead of paying endless debts. Number 1. Individual loans. The simplest method of debt consolidation is through personal loans. You request a loan large enough to pay off all of your credit card debt from a bank, credit union, internet lender, or possibly even a cousin or friend. If the interest rate is less than what you are now paying on your credit cards, it makes sense. It should be much lower if you have good credit. If your credit is bad, it might not be worth the hassle. The process is made simpler by personal loans, which is their best feature. Each month, you make a single fixed payment to a single lender. The loans are normally for 3 to 5 years, and if you pay them back on time, your credit rating should rise. Number 2. Transfer of credit card balance. A straightforward option to simplify payments and pay less in interest for an introductory period, often 12 to 18 months, is to consolidate a number of credit card balances into a single 0% interest credit card. It does, however, come with a hefty qualification. You must have a strong credit score. A score of 690 or higher is advised, which can be problematic if you're behind on your payments. Transferring balances to a single card is useless if you don't make any savings. Number 3. Loan for debt consolidation. Loans are available through banks, credit unions, and internet lenders, typically at reduced interest rates, and are intended to replace a variety of consumer debt with a single loan. Although debt consolidation loans can be beneficial in some cases, it's crucial to comprehend the conditions of each lender and the risks involved in late payments. Unsecured loans can be obtained from banks, credit unions, and online lenders, albeit they can be picky about who they allow. The lowest interest rates are offered to those with the finest credit scores. Shop around because credit unions typically provide better deals than banks. In comparison to banks or credit unions, online lenders frequently approve loans in a matter of days and accept borrowers with weaker credit scores. Attention! The interest rates may be significantly higher. The worst option, one you should probably avoid, involves storefront lenders and debt consolidation companies that add extra fees for originating loans and charge much higher interest rates. Avoid consolidating credit card debt with for-profit companies and always carefully review the terms. The debt consolidation loan business has a spotty reputation, and there are many scam artists. Be diligent. Avoid credit repair scams. Number 4. Home equity loan or line of credit. Home equity loans and their variant, home equity lines of credit HELOCs, formerly known as second mortgages, allow you to borrow against home equity. The difference between how much your home is worth and how much you owe, usually at rates far lower than you're paying on credit card debt. The downside, your house secures the loan and you could lose it. The house, also known as collateral, is why you get a lower rate. If you are comfortable with that, equity loans allow you to make regular, predictable payments. If you have sufficient equity in your home and you meet other income and credit standards, you can take a loan or get a credit line that will allow you to transfer all your credit card debt to a home loan you can repay in regular installments. Financial advisors often warn clients not to convert the unsecured debt on credit cards to a secured debt on your home for that reason. Your home is among the possessions you can protect from creditors even in bankruptcy. The same holds true for another home loan option, cash out refinancing. In this case, you refinance your primary mortgage, turning it into a larger loan with, hopefully, a lower interest payment. You use the cash you take out of the refinancing to pay off your credit card debts. Lenders sometimes make paying off listed debts at closing. You never see the cash as part of the approval process. Again, turning unsecured debt into secured debt is a risky maneuver. Number 5. Ask friends or family for help. We don't know the nature of your relationships, but know that the moment borrowing from a friend or family member pops into your head, things change. Make certain you can afford and will deliver on the repayments. Discuss upfront what happens if you can't live up to your side of the bargain. You may conclude the risk to your relationship is too steep a price. On the upside, you probably won't have to meet minimum eligibility rates, and you may end up with a very favorable interest rate and repayment terms. Number 6. Borrow from retirement. Borrowing from an employer-sponsored retirement plan, such as a 400 and on a loan, gives you access to money that can be used to pay debts. Before considering this alternative, understand restrictions that apply to retirement account borrowing. You have 5 years to fully repay a 400 and on a loan or face early withdrawal and tax penalties. If you leave your job for any reason, You have to repay the loan balance within 60 days or pay early withdrawal penalties. You can't borrow more than 50% of the vested value of your $400 in ONIC, and your loan can't exceed $50,000. Remember, this is your retirement money. If you fail to repay it, you will lose the money. Even if you do repay the loan, you will lose whatever growth the amount you borrowed might have accrued. In short, don't get the idea that borrowing from your retirement account is a terrific idea. It's not. Number 7. Cash-out auto refinancing. Cash-out auto refinancing works similarly to a cash-out mortgage refinancing. You refinance your CarTrack SUV assuming you're not upside down on the auto loan and use the cash to consolidate debt. Again, shop hard. Different lenders may appraise your vehicle differently, affecting your available equity, and you're likely to encounter a range of interest rates and fees. Also, again, if your vehicle becomes collateral in your debt consolidation plan and you can't keep up with the payments, you're putting your reliable transportation at risk. Whatever you do, do not confuse cash-out auto refinancing with car title or pink slip loans, short-term loans at notoriously high interest rates in which the lender can take your car if you default. Avoid car title loans at any